Great. Well, good afternoon, everyone, and welcome to this QT Cares session. So I'm really excited again to do this second workshop with our team here from SunLife. And but just quickly before we kind of dive in, and I want to leave a lot of time for you to see the presentation and also ask a lot of questions. As you know, QueerTechs have launched our QT Cares program in the spring 2020, and it was an initiative when COVID hit. And we're really looking to focus on three things: supporting the community on financial health, mental health, and physical health of the community. So last year, we've done some series around physical and mental health, and we started, as of last quarter, we started this series on the financial health of the community. So I'm really excited to have Jeff and his team here to present to us. And so I'm going to pass it on so you can get started.
Thank you, Nofel. Let me share my screen first. Okay, hello, everyone. I'm glad to see that you all survived the snowstorm. And thank you for being here today. We're obviously living in a very difficult time, and many of us are going through various obstacles, both physically and mentally. So I want to take this chance first to thank QueerTech and Nofel's team for organizing these online events and webinars to bring us together as a community. So I hope we can reach out to each other for love and support and be optimistic that things will get better. We partner with QueerTech to help QT members to break down barriers of building wealth in the LGBTQ2+ community. And we aim to create safe space and make you feel very comfortable when working with a financial professional for the long term. So today, as you can see, is the second webinar out of a series of 6. If you haven't watched the first one, or if today you cannot stay for the whole term, feel free to go to QueerTech's website, and it's all recorded and you can rewatch it at your convenience. So we are a team of 3 at the moment, and we can advise clients in English, French, Mandarin, and Spanish for holistic financial planning needs. I am a certified financial planner, and both Fernanda and Julien, who are in the call today, they are licensed financial advisors. So we try to understand your current situation and your future goals and aspirations, and aim to bridge the gap for you over time. So of course, we know that goals and aspirations change over time as well. And as humans, we are very bad at picturing future selves. That's why it's very important to work with a professional when your financial situation is getting more complex, because financial planning is a very dynamic process. So feel free to reach out to us by email or talk to us by LinkedIn, ask to continue the conversation. And throughout the presentation, if you have questions, you can save until the end for the Q&A, or you can put in chat, and Julien and Fernanda will try to reply you while I'm presenting. So the main focus of today's presentation is on investment fundamentals. So investment management is a very important aspect of achieving lifetime financial securities and freedom. So I aim to give you a framework of how to think about the basics. And followed by that, we'll also have a section specifically dedicated to responsible investment, because it's important for investors like yourself to not only grow your wealth over time, but also understanding the companies that you are investing in, if they suit your values. And Julien, he will be presenting that section, because Julien he's a licensed responsible investment specialist, and he's an expert on the subject. So before I begin, a quick disclaimer, the information is for general information purpose only. And if you want to make financial decisions or major financial decisions, consult a financial professional first. And the key is really be aware of taking financial cues and advice from people playing a different game than you are. I think like it's very important for the advisors or your professionals to understand who you are first before giving you any advice, because people like advice are different for different people's situation. So before I begin like today's content, I want to give you a quick recap of what we talked about last time. So the last time the webinar was focused on the overview on financial planning process and how to build wealth over time. We break down the process of building wealth into several steps. And the first one is that you need to define your goals. You need to set a smart goals, like specific, measurable, achievable, realistic, and time bound. Try to define your goals with specific dollar signs and a reasonable time span to achieve that. Because like if you don't know where you're going, most likely you'll end up somewhere else. We talk about different registered accounts and non-registered accounts, including RRSP, TFSA, RESP, and non-reg in general. We talk about the magic of compounding and how important it is to start early and take advantage of time in the formula of growing your wealth. We talk about the importance of setting up like automatic and regular contributions into your various plans, because we know as a fact that even if you know all the financial knowledge in the world, it doesn't guarantee that you will have a behavioral change. So it's important for you to set up something automatic to make the process as painless as possible. It's like a nudge for you to grow your wealth over time and let the market play its magic over time. We talk a little bit about investor behavior and how people are not rational when the market crashes, and how important it is to stay invested to avoid buying high and selling low. And lastly, we talk about seeking help. Like we talk about the benefits of working with a financial professional to guide you through the process, especially when your situation gets more complex as you move across life stages. I'm not going into details, but there is like a quick slide on the pros and cons of different registered and non-registered accounts. So like I strongly recommend you to go back to the recording if you don't know the differences. This is especially interesting now because the RSP contribution time for 2021 tax year is coming at the end of February, specifically March 1st this year. But if you don't know what does it mean, like go back to the webinar or reach out to us for help. Okay, so I'm gonna jump into today's content. So when we are talking about investments, I think one of the first questions you should ask yourself is how much risk can I take with my money and how much risk do I want to take? So this is a question of capacity versus willingness for risk. So this chart shows that investments fluctuate over time. And I think it seems like a very, very simple concept, but our experience when working firsthand with investors is that when people face market volatilities in their portfolios, they panic and they make bad financial decisions. Historically speaking, market rewards investors that take risks over time. For example, like the average return on global equity market is way higher than the fixed income market in general. For most of the time periods. However, it is also important to really understand, you really need to understand the capacity for risk and willingness for risk before making any investment decisions instead of following the hypes and peer pressure. This goes back to what I said about be aware of taking financial cues and advice from people that are playing a different game from you than you are. So there are different kinds of risks. I think this chart shows market risk the most, and it's just one type of risk, market risk. Another risk worth mentioning is inflation risk. So when we're talking about the value of money, it's so important for you to understand that it means your real purchasing power of money, not just the dollar sign. And most likely, you're losing value if you capture money inside a safe savings account at the moment. And therefore, it's very, very important for you to allocate a portion of your money into medium and long-term investment goals and make them grow in terms of real purchasing power. Okay, so how do you do a risk assessment? I think this goes back to the theme of the first presentation. You really need to define your goals first. For example, like if you are investing in your RSP or in your defined contribution plan through your employer, and you don't plan to touch the money for decades, then you most likely you have the capacity to take risks for potentially higher average return over time. Versus like many of you may had or are planning to purchase, let's say, a condo in a year or two, then most likely your capacity for risk is very low. Because like, and you may want to put the majority of the money that you're going to use to make this major purchase in a safer investment option. I can give you another example, like speaking of buying home and purchasing home, like we work with so many young professionals that they have a major purchasing goal, yet in their portfolio is majorly like they're trading or they're mostly in individual stocks, which obviously doesn't suit their risk capacity based on their goal. And then once understanding the factual capacity is about your own psychology. So everyone has different experiences with money. So everyone has different reactions for taking risks when it comes to money. And it's very important to have an open conversation with your advisor, or like just working with yourself to understand what kind of investment experience you are looking for. I think it's so important to understand that it is your money, and like you should invest in a way that enhance your well-being, but not always causing unnecessary like stress for you. So it's not the advisor's job to actually define these goals for you. It is your job to understand what is important to you first. Okay, so this part is the risk. So that's like the first thing you should understand of the like how much and how much you can and willing to take risk. And the next part is, after understanding the risk, you can talk about asset allocation, meaning that what you should invest in your portfolios, like or what kind of portfolio you want to have for your overall investment strategy. So today, like I will give you an idea of what does diversification mean and how do you achieve diversification as a retail investor. Okay, so we will start with the why of diversification. So there's like an old saying that like do not put all eggs in one basket because you could lose everything. Which is true. Like a simple answer to the why of diversification is because winners rotate and it is random. So this chart shows that the average annualized return across different countries in developed markets in the past 2 decades. Actually, it's 2001 to 2020. And there are 2 things you can see. The first thing is that there are so many countries to invest that you may never thought about. Like perhaps most of your mutual fund portfolios are very concentrated in North American market. Yet you may not think that Denmark and New Zealand were the winners for the past for the time period. So it's very, very, very important for you to be able to expose yourself, your portfolio to different geographic locations. Like let's say Canada was like 5.2 versus Denmark was 10.7 over the past 2 decades. Secondly, without doing like a statistical analysis of correlations, it's clear to see that the ranking is very random, and it's impossible for anyone to predict the future winners and losers of the like different countries. So therefore, the best way for you to capture the market return is simply by owning them all. This chart shows ranking by asset classes rather than countries. Diversification doesn't only mean geographic diversification, as shown on the last slide. It also means diversification in asset classes. So remember, there are four main asset classes, namely stocks, bonds, real estate, or REIT, real estate investment trust, and cash. And under each asset class, there are subcategories. Let's say for stocks, there are US equity, international equity, emerging markets. And then under each subcategory, there are like subcategory of like large cap, medium cap, large cap. And for bonds, there are, let's say, governmental bonds, municipal bonds, corporate bonds. So like you should try to aim to build a portfolio in a way that you have access to all asset classes, or as much as you can. So similar to the last chart, this chart, I think you can also see that the ranking in terms of the asset classes over the 10-year period was also very random. So the best way for you to capture it, the return, is by owning it all. As a retail investor, like I assume most of you are retail investor, not institutional. So the most common way for you to diversify your assets in the registered and non-registered account, I think there are several. The first one is like by buying mutual funds, ETFs, like index portfolios. Those are like managed solutions of different indexes. You can also buy individual stocks and bonds, like individual stocks and bond contracts. I think each has its pros and cons. Today, I'm not going to go into details, but if you want to discuss more which way suits your situation the most, feel free to reach out to us afterwards. There are alternative asset classes too. So on top of the main ones I mentioned. For example, like for financial, there are options, futures, cryptos, and NFTs, which are very hot right now. Some people, they buy real metals for gold and silver. I suppose like most of you won't do that, but it is like a way to diversify your assets. Real estate, and lastly, life insurance actually can be a separate asset class as well. I will talk a little bit about it later, but it's not suitable for everyone. It's usually for people that are wealthy or for people that already at least fully invested in their registered accounts. Okay, so the last part of my presentation is to give you some tips or thoughts on certain topics that can help you with your investment journey. I think they are very, very general tips. So it may not suit everyone, but I think those are like generally true to most people. So the first one is this slide is about the common mistakes we see when we work with our clients. The first one is like a lot of people they try to outguess and time the market, and you need to understand that market is inherently very efficient, and it's almost, I would say, it's impossible for you to be able to consistently able to forecast the best timing to get in and out of the market. If you think you can, most likely it will be the third point. You will let your emotions manage your decision, and you will follow the behavioral finance traps. And most likely over time, you'll be buying high and selling low. And also like past performance doesn't predict future performances. So like a lot of people, like they chase the past performances. An example would be like if, for example, you are buying a very hot stock like Tesla, let's say, like for a short-term period, most likely it's already very expensive. And this ties to the fourth point of like looking too close to the headlines. You should regard these news items or the Reddit posts or whatever like as like noises when you are making long-term financial decisions, because whoever is promoting the information, they don't know you and your situation. So be careful when you are making any financial decisions because the others are doing it or because you read it on different social medias. Lastly, not diversifying enough is like definitely one of the main thing we see. For example, like we see so many young professionals, especially well-educated. I suppose most of you here fit into that category. We see a lot of portfolios like holding majority are like large cap technology firms in the US, and it gives you the impression that the portfolio is diversified enough. But based on the charts I just showed you, like it's a small subset of the asset classes that you can own. And it's very important to look at the bigger picture when constructing your overall portfolio. Because like if you focus so much on the present, like what is hot right now, like you could lose significantly like when there's a correction in the market. The next 3 slides, I will take most 1 minute per slide. I will talk a little bit about trading crypto and using life insurance and asset classes. I am not an expert on trading nor crypto. I can say I am an expert on life insurance strategies, but I still want to give you a bit of information regarding to like each topic. Because most of us are stuck at home, and there's like abundance of information online, like about trading, about seeing people getting rich because of whatever stock they buy. I think a lot of people are rushing into the self-direct like accounts, or they do the DIYs. Important to understand that day trading is a full-time job. It's not a casino game. Like if you, for example, you just buy the stocks that for the short term that you think they will grow, it is cost speculation. It is not investment. And from a financial planning perspective, like apart from investment returns, it's so important to understand that, like first of all, like they cannot be included in registered accounts for like too much trading. Sorry, you can't include stocks and bonds, but if, for example, you do day trading, the tax deferrals or TFSA, the tax elimination, they will be considered as income for you if you do day trading in them. And be careful with trans diversification tax implications, because a lot of people, they don't understand what is the market value and the book value when they buy and sell. And I've seen people that receiving like huge tax bills at the end of the year, and they didn't factor in that it is a realized gain or loss. And obviously diversification, if you do day trading, most likely you won't be able to have a diversified portfolio. You'll be just choosing the companies that you know or that you're passionate about. There's nothing wrong about that. But I'm just saying that it's important to not let those stocks or bond contracts dominate your overall long-term investment strategy. Market have usually rewarded long-term investors. This is very true because like, of course, you can see news of people losing all their money by trading or by buying options or futures. But most of the news you hear are success stories. But we see so often that young professionals without much savings, but doing a lot of tradings, and in the end, like they have to restart their savings because they lost everything. So be careful if you are doing the day trading. It is a very complicated and sophisticated practice for you to do. The next part is about crypto. Like I said, I'm not an expert on crypto. Individually, I do have holdings, but I don't advise on that. And I think maybe many of you in the call or watching this webinar are are experts on the technical side of it. I just want you to know that important to understand that like it's totally fine for you to own crypto, but it is highly volatile, and you need to be ready to lose everything of what you put in. It is, to me, it is alternative asset class, and do not put like more than like 10-20, do not put too much percentage of your overall wealth into things so volatile. You can put some money that you don't think you will need, and try to have some aggressive growth, but do not put all the eggs in one basket. Be careful with tax implications. I've seen huge tax bills because of crypto, especially for the early investors. And those can, of course, you have the money. Most likely, you have the money to pay for the taxes, but be careful. It is taxable in Canada, and it is just like a regular investment when it comes to like tax planning. Look for the red flags, meaning that there are so many new cryptos coming out like all the time, and a lot of are scams, and a lot of them are very good at promoting themselves and marketing themselves. So do not buy what you don't know about. So like if you see someone is buying a certain crypto, do not buy without understanding like what like without understanding it. Like this can save you a lot of regrets. And lastly, Julian, maybe he will talk about later, but the crypto is not environmentally friendly at all. Like if you think that if you are very being environmental friendly, or you want to be responsible with your investment, the crypto may not be the best choice in terms of that. Lastly, for me, I want to quickly talk about life insurance. I think many of you do not see life insurance tied to financial planning process for building wealth. And you are right, like for most people, like for example, if you are in the process of saving more for registered accounts, do not use life insurance as an investment strategy. The main goal of life insurance is always protection. However, there are certain permanent life insurance policies that you can invest within the policies, and it is tax sheltered for death benefit purpose. So I have most of my like wealthier clients, they have life insurance in their portfolio because they want to plan for retirement or plan for estate purposes, but it's not for everyone. It is an alternative asset class for safe growth because most of the insurance companies, especially in Canada, they invest in like governmental projects or asset classes that you cannot access as a retail investor. So you receive dividends from those investments, and it can be an interesting strategy if you have quite a bit of cash. Also like important to understand that you should focus on the registered investment and liquidity first. I do know many advisors would push life insurance as a investment item, like even if you don't have much savings, and be careful with working with these advisors because they have their self-interest in that. But I'm just saying that it is an important aspect to think about once you have a certain level of wealth. Okay, so I'm going to pass the stage to Julien. As I said, Julien has he's a responsible investment specialist. He's actually certified for that and passed courses for that. He will be talking about responsible investment, and then after that we will jump into Q&A.
Thank you, Jeffrey. So hi everyone. Sorry. So we wanted to end that presentation talking about responsible investments. Jeffrey talked to you about diversification, what kind of investments you can look into to diversify your portfolios, etc. But a lot of them nowadays want, on top of all these technical aspects, we also want to make a difference, right? To not invest like our parents and grandparents who were putting money at the bank, forget about it, and wait on the long term. Now we want to know that the money we invest maybe or most likely will make a difference. So Jeff, can you?
Yeah, of course.
Yeah. Thank you. So like I said, nowadays we know the key issues. Like we all know, we have no excuses. We know the issues about environment, about health, about food, about the pollution. All these key issues, we know about them. And until not so long ago, when we were talking about investments, you would hear like financial specialists, banks, etc. They would tell you that you have to choose. You have to choose between performance and purpose, or sustainability, responsibility, etc. They were saying that for years and years and years. Actually, nowadays we see that it's not true, and it was never true. Like when you look at the statistics at mutual funds that are said to be responsible, we see that it's not true, and it was more something to like marketing. So nowadays you can definitely make a difference, or at least do more than just looking at performance. You can have both, actually. And the basic thing you should look into, you will hear about it like all the time. It's called ESG. Jeff, you can, yeah, so exactly. So ESG stands for environment, social, and governance. You will, if you didn't hear about it right now, you will hear about it for sure in the future. For now, it's very trendy, I would say. So be careful, because regulations are not, in North America, regulations are not as good as in Europe, for example, or other countries. So a lot of people will talk about ESG and they don't really expect you to understand what it is. So they will just use it as a marketing sales point, basically. But so you understand what it is, ESG is the base of responsible investment. It's really the first level. It's basically a ranking, an analysis, some kind of score you give to companies depending on their actions regarding these three themes: environment, social, governance. You have some example. Of course, we know what is environment is, but social and governance, you see, sometimes we don't really know what it means. You can see some examples here, especially governance. It's about like diversity in the board, conflict of interest, executive remuneration, these stuff that we don't really hear about. We didn't really hear about it like for years, and now it starts to be very, very important. And this analysis, this ESG analysis, as we call it, nowadays, most of companies are going to do that analysis in parallel of the financial analysis. Financial analysis is that regular analysis that everybody was doing since forever. It's to know, like, financially, if your company is sustainable, if it's going to grow, if it's doing well, basically. But now they integrate this ESG analysis. Why? It's because at the end of the day, a company that is sustainable on these environment, social, governance topics, the company will go further. On the long term, the company is more sustainable. It's not only responsibility, it's also like sustainability for the company itself. So that's why nowadays all the companies will have that. And it's very good, but it's just a base. And you will have a lot of mutual funds or ETFs where you can invest that are stamped as ESG. It's just basically, it's a little bit more than just passive investments in a lot of companies. It will be passive investments, but in companies that are in this top ranked like ESG companies. For example, like with these ESG factors, you can establish a ranking, sorry. Let's say you have 1,000 companies that are ranked, and some investment companies will build their portfolio, their funds, depending on that ranking. And we'll say, okay, we'll only invest on the top 300, 400 companies. That's a good base. That's the minimum. And you should, at least, if you really care about responsible investment, when you will look into mutual funds, ETFs, etc., you should definitely look into ESG funds, because it will at least be the base for responsible investment. But on top of that, you can go really further. And by you, I mean the investment companies that you trust and you invest with them. They can go further, and they should go further with a responsible investment. First, the second level would be exclusions. Of course, like you can exclude, for example, tobacco companies, you can exclude gambling, so casino industry, You have to like look into it. It depends on the funds. It depends on the investment company policies. So it's interesting to really look into it because it's a second level. When you have ESG only, doesn't mean that you're not investing in the tobacco industry. That's kind of weird, but that's what it is. That's why you have to look into it a little bit further. The third step would be to make a real impact and be able to measure it. So basically, investment companies will say, if you invest in this fund, then we can show you that there is a social and environmental impact, and we can measure it every year. It's tangible, and you can see that they make a difference. And just with that, there's really like, you can really see that the investment company has a responsibility to show you that what they do with your money is not just passive investments, it's not just performance, it's mainly making a difference on top of the performance that you get. And I would say that the last level is very, very interesting. It's still very rare, but investment companies will go further than just screening for the shares, screening for ESG companies. It will go further than that. They will basically engage on your behalf and keep the companies accountable. For example, like if you decide to invest to make a difference, you can take your few $1,000 with you maybe, and you go to in a company and you say, okay, I'm investing all my money in one company, a local company in Montreal, I don't know, because that company is making a difference. And then what? Are you able to make it like a difference, to make an impact? Can you really be proposing some kind of changes in that company? It's very hard because you represent a tiny part of the investments of that company. When you have like a huge investment companies and huge mutual funds, we talked about mutual funds or ETFs, these big funds, they have millions of dollars because they have millions of investors in it. So in this case, the investment company will invest millions of dollars in different companies. And they have a lot more weight when it's about proposing some like changes in the company, when it's about to sit at the board, I mean, or actually like push the board of director to make some changes, to vote also. Like when you have shares, you can be a voter too when there's decisions to make. And when they have that weight, when they have these millions of dollars investing in these companies, they can make a difference. They can engage on your behalf. Sadly, not all of them are doing it right now, but some of them are doing it. And if you're really interested in that, that's your responsibility to really ask the bank. If you do it with the bank, you ask your advisor, if you work with an advisor like us, you have to say, listen, I'm interested in responsible investment. I want to know more about what you are doing as an investment company to make some change and be sure that my money is just some kind of passive investment and that we don't do anything with it. You have to ask for that if you really want it. Because nowadays it's coming, it's here. It's more and more important, especially since the COVID crisis, but still you have to word it, you have to say it, and you have to ask for it. So keep that in mind. That's just an introduction today, but if you want to discuss more about it, Jeffrey, Fernanda, and I are here. So just ask us some question and we can even help you invest in responsible investments.
Thank you, Julien. I think to us, responsible investment is so important to our values as the three of us. And when we are having conversations about investment management with almost all our clients, we always draws in the lens, like try to talk about responsible investment to make an impact this way as well. So thank you for the summary. So that concludes our presentation today. I hopefully you have a better understanding of how to think about investment management from a very basic level, and also have a better understanding of responsible investment in general. But as I said at the beginning, by equipping yourself with this financial knowledge, or even if you're the most financial literate person on this planet, it doesn't mean that you will do something to make it happen. So like, I think part of the reason for working with a professional team is to actually coach you on how to get there, and to understand you, who you are as a person, your psychology, your aspirations, your fears, and then to have a plan that actually is doable than just being an expert on a subject. So we put our contact here. Feel free to send us an email. And we are very, very approachable people, and hopefully we'll see you in person someday soon. Like, we can chat over a drink, like Sanka said, whatever. And we really look forward to that. But for now, if you want to connect with us, it will be virtual, and I will be more than happy to have a conversation with you. Okay, back to Nofel. Thank you.
Thank you so much, Jeffrey and Julia.